This is how wealthy people make money and avoid paying taxes legally. Hi, welcome to Real Money. I'm Khurram Shahzad. I'm a real estate agent, founder of NIDUS Group Real Estate and H2O Loans. In this channel, I'm sharing my knowledge and experience about property investing. I came from a humble background. At the age of 18, I moved to Australia, and with 10K savings back in 2008, I've been able to grow an asset portfolio of over $10 million. So if the topic of around wealth creation, property investing, and building successful life interests you, please hit the subscribe button so you don't miss out on future videos. Number 1, the wealthy shield their assets from tax whenever possible. They don't own anything, their trusts own everything. Here's how this works. Asset ownership in trust. Instead of owning assets directly in their own name, some wealthy individuals use trusts to hold and manage their assets. Trusts are legal structures. They allow assets to be held and managed on behalf of beneficiaries. Tax efficiency. Structuring assets through trusts can offer tax benefits. Income generated by assets held in trusts can be distributed to beneficiaries in a tax-efficient manner. Trust income can often be distributed in a way that minimizes the overall tax liability to the beneficiaries. Superannuation as the best tax shelter. In Australia, superannuation is a government-mandated retirement savings system. It is a tax-advantaged structure that allows individuals to save for retirement. Concessional super contributions, which include employer contribution and sacrifice contributions, are taxed at a lower rate of 15%. This is particularly beneficial for those who are under the age of 60. If an individual is over 60 and retired, they can potentially enjoy a 0% tax rate on their superannuation income. Trusts and superannuation. Wealthy individuals may use trusts in conjunction with their superannuation to optimize their tax planning. For example, they can make concessional super contributions from trust distribution to take advantage of the lower tax rate. Number 2, the wealthy directly control their superannuation funds through a self-managed super fund. This approach provides them with a greater control over their investments, including the choice of asset classes they want to invest in. Many of them decide to invest in real estate, which can help increase their wealth due to several advantages, including lower taxes. Here is the breakdown of this strategy. Number 1, greater control. Self-managed super funds allow individuals to have direct control over their retirement savings. This means they can make investment decisions based on their specific financial goals and preferences. Diversification. Wealthy individuals can diversify their SMSF portfolios by investing in different asset classes, for example, property, shares, cash, and more. This diversification can help spread risk and potentially enhance returns. Property investment. Real estate is a popular choice for many SMSF investors. By investing in property, individuals can benefit from the rental income and potential capital appreciation over time as well. Now, tax advantages. Investing in property through an SMSF can offer tax advantages. For example, rental income received by the SMS is generally taxed at a concessional rate of 15%. Additionally, capital gains on investments held for more than 12 months receive a 50% capital gains tax discount. Number 3. The wealthy often employ strategies to minimize their tax obligations legally, and one such strategy involves avoiding paying voluntary taxes like capital gains tax. Here is how they typically approach it. Buy and hold strategy. They purchase income-producing assets with the intention of holding on to them for an extended period of time. This strategy helps them avoid realizing capital gains, which would trigger a CGT liability. CGT discount. In Australia, if they hold an asset for at least 12 months, they may be eligible for 50% CGT discount, which they eventually sell the asset. This means they only pay tax on half of the capital gains when they sell. Tax shelters. Some wealthy individuals choose to hold these assets within tax advantage structures like superannuation. By doing so, they can potentially eliminate the CGT liability. Altogether, especially if they are over 60 years old and have retired in this case, they can sell assets held within superannuation without incurring CGT. Retirement benefits. The tax rules around superannuation are designed to provide retirement benefits to individuals. For those who are over 60 and retired, the sale of assets within superannuation can indeed be free from CGT, making it an attractive option for long-term asset holding. Number 4. The wealthy get paid a small salary. It's not uncommon for some wealthy individuals to receive a relatively small salary as a part of their overall income strategy. This is often done for various financial planning and tax optimization reasons. Here's a breakdown of why they might do this. Tax efficiency. High-income individuals often have various sources of income such as investments, dividends, capital gains, and business profits. These type of incomes may be taxed differently than regular salary income. By taking a smaller salary, they may reduce their exposure to higher income tax rates that apply to traditional employment income. Income splitting. Some wealthy individuals might have family members or spouses who have lower income tax brackets. By taking a smaller salary and shifting income to family members in lower tax brackets, they can collectively reduce their overall tax liability. Asset protection. In some cases, high net worth individuals may use legal structures like trusts to manage and protect their assets. These structures can provide added asset protection and tax benefits, but they may require a lower personal salary. Retirement planning. Wealthy individuals may prioritize building wealth within their investments and assets rather relying on high salary. This allows them to accumulate assets for retirement tax deductions. By taking a smaller salary, wealthy individuals may also be able to claim certain tax deductions and credits, further reducing their overall tax burden. Number 5. The wealthy borrow money against their assets and they do this to reduce their taxes. However, it's important to clarify that borrowing money itself is not tax-free. The key difference lies in how the borrowed money is used and how it's treated for tax purposes. Here's how this strategy works. Using assets as collateral, wealthy individuals often have valuable assets such as real estate, stocks, and other investments. They can use these assets and collateral to secure loans from financial institutions. This is often referred as leveraging or taking out a loan against the value of their assets. Tax treatment. The borrowed money is generally not considered taxable income because it is a loan that needs to be repaid, not an income generated through employment or investments. Borrowed funds are not subject to income tax. Investment and tax efficiency. Wealthy individuals may use these borrowed funds to invest in income, generating assets or opportunities. The interest paid on the loan may be tax deductible if the borrowed funds are used for income-producing investments. This can result in a reduction of overall tax liability. Capital gain tax. If the borrowed funds are used to acquire or improve investments, any capital gains realized when these investments are sold may be subject to capital gain tax. However, these tax implications can vary depending on factors such as the duration of the ownership and the specific tax laws in place.